Hello friends, welcome to the Indian Psychologist. In today's video, we will take a look at why the stock markets are going higher and higher. If the real economy is so bad as everyone says, then why is the stock market going higher and higher? But before that, this being a channel on psychology, why are we even bothered to talk about the stock market? Isn't that something that only finance professionals should talk about? Now, even though stock market is a place where a lot of financial transactions happen, and its functions are believed to be an outcome of companies' financials, it does not always work that way. If the markets are always fair and are always built on logic, then we would never have bubbles. If you don't know what bubbles are, bubbles happen when a lot of people want something that is scarce in quantity and the price of the product shoots up to such a crazy extent, everybody has forgotten what is the actual value of the product. Now, many people would say that we are currently in a bubble when it comes to the stock market, both the Indian and the US stock market and the stock markets world around. But the truth of the matter is that a bubble is only a bubble when there is no buyer in the market to buy the thing that you sell for the price that you quote. Until that very moment, everybody is going to believe that we are in a free market and everything is being priced into what people are buying. And people are buying something only because they believe that the price are going to go up in relation to other alternatives that are out there. Now, other alternatives. This is a very important thing to understand why stock markets are going through the roof. This is because of the fact that US Federal Reserve interests are close to negative, and there has been a dramatic decrease in the interest rates all around the world, and that includes India. Now, this raises an important question, and that is, which is the best place for my money to sit while the price of the products and the commodities are going up? How sensible is it for a person to have the money in hand or in a bank lying there without working? This is an extremely important question for any person who has money in hand. And when you look at the world, which is extremely uncertain, nobody knows what's going to happen tomorrow. Everybody's best bet is going to be on something that keeps appreciating in value. Every day you look at the news, every day you look at the charts, and what do you see? You see that the prices are going up and the stock market is going higher and higher. And everybody is going to have what we call as FOMO, that is fear of missing out. See, one important thing that we have to take into consideration is if price of everything else is going up, then the value of money is going down, and it is especially going to go down when it is going to sit in your hands doing nothing. Now you can ask me, FOMO happens after a few people have started running and few people have gotten ahead. But how did that initial trigger happen? The most important thing to understand is that stock markets are not a representation of the current economic state, but rather an indicator of future and where the markets are looking at and where the people are looking at. If you take a look at the US market, they have the FANG stocks, which have only appreciated in value during the pandemic. And when it comes to India, everything was lying a little dormant until Jio got its valuation from the FANG stocks, until Reliance started reaching new heights. Yes, if a stock is part of an index and the stock price goes higher, then the index must go higher. But it should only be marginal, right? For the people who don't understand what an index is simply a collection of a group of stocks put together in various proportions to create value for an investor or to indicate where the markets are heading. Now, if Reliance is a part of an index, or if FANG stocks, namely Facebook, Amazon, Apple, Google and Netflix are part of an index, yes, if their stock price goes up, then eventually the index also might go up. But if they only have a certain percentage of the weightage on the index, then the index should not be shooting up that high, right? It's only logical, right? But one tricky part of this whole equation is the fact that everything in stock market is in relationship to another. How do you value a company? Yes, the valuation of the company does certainly depend upon what is the actual valuation of the business, what is the profit that they are making, or what are the future growth expectations for the company. But it doesn't only end there. It also will depend upon the fact how a similar organization is being valued. And not only a similar organization, it is also going to be on a similarly sized organization. Now let's take Reliance and Tata. They might have a few areas in which they might share the market space, but they might not be exactly doing the same business. Let's take TCS and Reliance for example. In that case, what happens is that markets will try to factor in if Reliance is worth that much, then what is the worth of TCS? And if TCS is worth that much, then what is the worth of HDFC? And so on and so forth. With the increase in value of a particular company, the value of so many other companies get raised. Now, for a very logical man who is looking at all these things from the outside might think, this is crazy. If one stock goes up, it's because of the fundamentals of the organization. Then why do other companies go up as well just because one company goes up? And that is where the people's perception comes into the equation. When people perceive one organization to be superior over the other, and in spite of that fact, if the other organization is going higher and higher in the market, then the market will believe that the price of the company which is actually lower is actually in a discount. The market will believe that the company's stock which hasn't gone up is actually available at a discount, and by buying that they are going to make a tremendous profit. And markets are usually driven by greed or fear. While everyone is still fearful of the fact that a bear might strike at any moment in the market, everyone is extremely cautious, but nobody wants to miss out on the whole run and fun and to make a little buck here and there, which might actually make this seem like a really big bubble. But no one will be able to say whether this is actually a bubble or the market has actually priced in everything until the dust settles and everybody is able to look at the market clearly and everybody is able to look at the world clearly, at least relatively clearly. And until that moment, the stock market will keep going up. And when the stock market is going up, people who believe in other assets to be superior than stock market are eventually going to invest in them as well, and which might take the price of your real estate or your gold a little higher as well. And the people who sit on the sidelines will be called pessimists, while the people who take the ride will be called optimists, and the truth will only be known after the dust settles. So in one simple sentence, if you ask me why the markets are up, it's because certain companies are showing promise and everybody else is being seen in relationship with those companies, and this perception is moving the market higher and higher. If you would like to receive more such videos which relates psychology to otherworldly affairs, you can subscribe to this channel. If you like this video, push the like button. If you have something to add, please do so in the comments and share this video with the people who might like it. Thanks for watching this video and have a great time.